Wondering if that car sitting in your driveway can help lower your tax bill? Well, the short answer is yes, in certain situations, and if you do it wrong, it can trigger problems with the IRS. In this video, we'll break down exactly what you can write off, what you can't, and how to do it the right way. First, let's talk about eligibility. A lot of business owners think, if I have an LLC, I can just write off my whole car. That's not how it works. The IRS only allows you to deduct the business use portion of your vehicle, not personal use. So if you use your car 60% for business and 40% for personal, you can only deduct 60% of the expenses. This is where a lot of people go wrong. And here's something you may not know. Commuting from home to the office is considered personal. The IRS gives you two different methods to calculate your deduction: the standard mileage rate or the actual expense method. Standard mileage rate is the simplest option. You just multiply your business miles by the set rate provided by the IRS. It saves you time because you don't have to track every single gas receipt. However, there are rules. You must choose this method the first year the car is available for your business. You can't operate a fleet of 5 or more cars, and you can't have previously claimed certain accelerated depreciation method, like bonus depreciation. Your other option is the actual expense method. This involves tracking all the costs to operate your vehicle, including gas, oil, repairs, insurance, registration fees, and lease payments or depreciation. You then prorate these costs based on the percentage of miles driven specifically for business. So if you drive your car 60% of the time for your startup, you can deduct 60% of those total expenses. This may lead to a larger or smaller deduction than the mileage option, but requires much better record keeping. So what if you just bought the vehicle? Well, under Section 179 deduction and special depreciation allowances, you might be able to write off part or even all of the purchase price in the very first year. Maximum deduction limits depend heavily on the vehicle's weight and the current tax year. But keep in mind, while you can write off depreciation and the interest on your car loan, the actual monthly car payment related to your loan is not a deductible expense. If you want to safely maximize your deduction, track your mileage consistently, separate business and personal use, model out the right deduction method choice early, and keep clean records. Because the tax code changes and vehicle weight rules can be specific, be sure to consult with a tax professional or check the official IRS resources to ensure you're maximizing your savings accurately. Looking for more small business finance tips? Subscribe to our channel today.